Welcome to the Deep Dive. Today we're tackling what feels a bit like a stock market unicorn hunt. We're searching for high-growth stocks that are also somehow cheap and high quality. We took your sources and applied some we're calling the quadruple filter. Okay, let's unpack this a bit. We set the bar high, stocks under $15, with at least, and this is key, 100% projected upside. A consensus analyst buy rating, and they needed a minimum 3-star Morningstar quality assessment. That's incredibly strict.
It is, and what's fascinating here really is the core conflict you just laid out. I mean, stocks promising that kind of upside, they often come with serious volatility or, pretty shaky financial health, at least initially. We saw one, ENVX, its normalized return on equity was like negative 51%. Quality ratings, well, they inherently plenish that sort of financial instability.
Right. So how did the analysis even bridge that gap? You couldn't just sort data, could you?
Yeah.
You had to sort of extrapolate, find a verified path to success.
Precisely. Yeah, the mission shifted. It wasn't just data sorting. It became about strategic extrapolation. We had to focus only on verifiable catalysts, things that really justified both the huge growth forecast and that quality designation. It let us look past the current turbulence.
Okay, got it.
Yeah.
And that strategic approach, it led you to a small group of candidates, which you've organized kind of neatly by the catalyst type that got them through that tough quality screen.
Exactly. So archetype 1 we called structural growth. Think fintech re-rating. Here we identified SoFi. It's showing 113% projected upside. Its quality score and assessed 4 stars. That's really based on the structural edge it gets from its bank charter.
The lower cost of funds.
Right. Significantly lower. And the 100+% catalyst. It's that successful, verifiable shift to sustain gap profitability. That's what we think triggers a major market re-rating for them.
Okay, interesting. Now, this next one, archetype 2, is where the filter gets really clever, I think. Deep value and asset reversion. You highlighted FBRT, 108% projected upside. And it trades at a price-to-book value, PB, of just 0.73. Can you quickly explain why trading below book value gives it that margin of safety, that quality aspect?
Absolutely. Yeah. So a PB below 1.0 basically means the market values the stock at less than its parts are worth, in a liquidation scenario. That deep discount itself provides a kind of built-in safety net,
Okay.
which satisfies the quality filter requirement. And the upside here, it's not really about complex organic growth. It's mostly driven by that PB ratio just reverting, moving closer to its actual asset value.
Got it. Simple reversion. And archetype 3, the thematic high upside energy proxy. That one promised a massive 145% jump.
That's a strong thematic play. It's linked directly to, geopolitical demand for natural gas, specifically U.S. LNG exports. The required 3-star quality here, well, it relies entirely on picking a company within that theme that demonstrates superior low-cost production efficiency. And, just as important, strong financial discipline. That's what lets it handle those volatile energy cycles.
Right. And maybe quickly mention, the filter also kicks them out, right? It wasn't just about finding winners.
Oh, absolutely. It's worth noting how effective it was at weeding out weaker candidates. We saw companies like RELY, great company perhaps, but it failed purely on price, missed the $15 cutoff, trading at $17.20. And others, like that ENVX stock with the really negative ROE we mentioned, excluded because, despite the low price maybe, the metrics were just fundamentally unsustainable right now. So the filter really helps validate the quality of the ones that did make it through.
Yeah, that makes sense. So if we sort of zoom out, connect this to the bigger picture, you're relying heavily on these forward-looking quality proxies, aren't you?
That's the key.
So the main takeaway for you, listening, is probably the need for continuous monitoring based on that specific catalyst.
Exactly right. Take FBRT. The asset backing, the PB under 1.0, that's its quality anchor. But its operational efficiency, measured by return on invested capital, ROIC. It's currently quite low, around 1.81%. The whole thesis, the catalyst, depends entirely on tracking improvement there. You need to see that ROIC climb.
Okay.
And for SoFi, it's different but similar vigilance needed. You must watch its progress toward consistent GAAP net income. The selection only works if you track that specific path to, let's call it, normalization.
So what this analysis really shows is that these rare opportunities, this combination of growth, price, and quality, they seem to exist mainly when you define quality, not just by looking backward at stability, but by identifying a clear, verifiable path toward future financial health.
Well put. It's about that forward trajectory.
Okay, let's wrap up with a final provocative thought for you to consider. We briefly saw data on an insurtech firm, LMNFD. Their story relies on building, a low-cost digital moat. So thinking about risk, which of these catalysts carries the higher execution risk right now in this macro environment? Is it LM&D trying to transform insurance with that digital moat, or is it the overwhelming geopolitical demand that's driving that energy proxy?